Good morning, everybody. This is Brad Rustin. I want to welcome you to our ongoing coverage of various programs that the Treasury and Federal Reserve has been issuing relating to the CARES Act. It's my pleasure to be joined by a number of my colleagues this morning, Jon Talcott and Peter Strand, who are leading the firm's efforts on the Main Street Lending Program. They are both in our Washington, D.C. office. Jon, in particular, former regulator who has been with the firm for a number of years and is coordinating our efforts in this regard, is joining me. His colleague, Peter Strand, who is also assisting many clients both on the borrower and on the lender side of Main Street Lending. And then you have Brad and Craig in the financial regulatory space joining you again. This is part two of our ongoing presentations on the Main Street Lending Program. Somewhat fortuitously, over the last 72 hours, we've received updated guidance, updated FAQs, frequently asked questions that the Federal Reserve in Boston has issued relating to the program. And then many of you saw the headlines in the last 72 hours that changes were made to the different facilities to try to make the Main Street Lending Program slightly more inclusive. And we'll be talking about a number of those today. Last week, we focused on a lot of the obligations of lenders and a lot of the obligations that arise within the servicing arrangements and what we're predicting and expecting in terms of the obligations of servicing these various Main Street Lending Program loans. Today, we're really focusing on the borrower. What are the certifications and covenants? What are the implications, particularly in light of these changes that were made in the last 72 hours that may affect you as you're considering whether or not to apply for a Main Street Lending Program? But there'll also be a lot of information that is applicable to lenders that may also guide how you think about who the right borrowers are, who should be targeted for these Main Street Lending Program loans, and how they would fit into an overall financial strategy for different types of borrowers. So with that, I'm going to turn this over to Jon and Peter as they kick us off a little bit about the updates and some of the changes.
Thank you very much, Brad. This is Jon Talcott. I have, as you can see, there's a timeline here. I'm going to step back and kind of presume that everybody doesn't know all the details of how we ended up where we are and go through those very quickly with you. As you can see, the timeline is stretched from March 23 when the Fed first came up with the idea of a Main Street Lending facility all the way to June 8th. One of the criticisms you're hearing kind of in the background or maybe in the press is, gosh, this is taking an awful long time. I think it's important to underscore the fact that this, unlike some of the other activities the Fed has engaged in this cycle, like the secondary market corporate credit facility, the Fed has never done anything like this before. So this timeline on the third slide here shows how the CARES Act was passed March 27th, and then the Federal Reserve announced, its initial terms of the Main Street Lending Facility on April 9th, and April 30th they announced further terms, April 27th, and then yesterday they announced some more detail. I think what's important to take from this slide is this program has slowly been expanded and kind of given more definition, but it's really gotten to the point now where it should be very useful to both mid-sized companies, which is what its original focus was, and smaller businesses. Next slide, please. This quickly talks about Title IV, this slide. I mean, we don't really have to go into much detail here. Suffice it to say that Title IV is the section of the CARES Act, or the stimulus package, where $500 billion was set aside for, lending to assist businesses. Some of that was directly to the airline industry and other national security industries, but much of it's left for, mid-sized businesses. Next slide, please. The Board of Governors of the Federal Reserve has the power to implement these sort of things, but it's somewhat restricted, and it's important to define this versus, say, the Paycheck Protection Program. Under the Paycheck Protection Program, which was being administered directly by the Treasury, forgiveness of loans is permitted. Under this program, there is no forgiveness of loans, even though the loans are on very generous terms and are readily available. So, next slide, please. Now to the facility itself. If you look at all the, to give you some context here, you'll hear a lot about, market-based programs that the Fed has engaged in or is engaging in. Most of this is a general, if you look back at financial crises we've had over the last 30 years, I started out as a bank regulator during the savings and loan crisis. The biggest problem that you have is the credit markets might freeze up. So everything that's being done by the Fed right now is intended to prevent that from happening. So they've got commercial paper funding facility, money market mutual fund, term asset-backed securities facilities, secondary market corporate credit facility, and the primary market corporate credit facility. I deliberately went backwards in that list because the top one, the primary market corporate credit facility, is something of a complement to the Main Street lending facility, but is really for investment grade issuers, and is really more focused on the market for bonds that are issued by public companies. But it is also, with the Main Street lending program, a unique program to this cycle. There wasn't a program like that in the financial crisis. There wasn't a program like that back in the dot-com bubble burst. There wasn't a program like that back in '87 or during the savings loan crisis. So these are complementary but unique programs, and they're all being administered by the Fed. And the thing that's important takeaway there is that the Fed is able to take the money that has been given under the CARES Act and multiply its effectiveness because they lever it up and make more money available through their facilities. Next slide, please.
One thing too, John, that I thought was interesting that you pointed out to me is if you think about how they're levering that baseline amount of funding all the way up to the facilities that they have in place, this proposed $600 billion facility, that gives you some picture as to how the Fed is viewing the prospective losses on the Main Street lending program. If you think about, how that initial funding amount, that $75 billion, is going to lever up to $600 billion, clearly then it's not being set up as a grant program where they're expecting to eat a lot of those losses. It's expecting to operate at, market or near market levels, given that ratio of the initial funding versus the total funding that they're putting available to the banks. And so I thought that was a really neat point that you made.
Yeah, it's interesting. If you look at one of the things that was on that previous slide, is this is all done under Section 13.3 of the Federal Reserve Act, which was amended after the last crisis to make it clear, under Dodd-Frank, it was amended to make it clear that the Fed cannot lend to insolvent institutions and cannot put itself at risk for losing the money that it lends out. Otherwise, the whole financial structure might be, threatened if the Fed overdid its lending to people who are unable to pay back. So that's what's driving that philosophy at the Fed. And as you pointed out, it's an important difference between this and the Paycheck Protection Program. Next slide, please. I think that the important takeaway here is, some of you or many of you who have focused on this program know that there's 3 different facilities. Originally, there was just 2: the Main Street New Loan Facility, and then the Main Street Expanded Loan Facility. And the Fed saw a need to have, a third option, a more flexible option, and they announced after their initial announcement, their second announcement, they said, we'll have a Main Street Priority Loan Facility. When we speak in terms of facilities, it makes it a little bit more difficult to understand. Basically, the Fed is setting up SPVs that will purchase loans or portions of loans that are originated by banks. So this is just setting the table. This is like the infrastructure that the Fed's putting in place, specifically the Boston Fed, is putting in place to help banks across the country lend more money and take that risk off their balance sheets by having them turn around and sell most of those loans into these SPVs. So the Treasury has said, it's going to be $75 billion they're going to make available. That will allow the Fed to make as much as $600 billion as loans, as we were talking about before. Eligible lenders are, across basically insured depository institutions generally. Next slide, please. Peter, do you want to talk about the eligible borrowers?
Absolutely. So at the highest level, eligible borrowers are businesses with up to 15,000 employees. When this was first announced, it was 10,000 employees, but it's now 15,000 employees. And that's so either 15,000 employees or $5 billion or less in 2019 annual revenues. When this program was first announced, that was 2.5 billion. So it's increased. It's important to note that the same SBA affiliation rules that applied to the PPP apply to this program. So when you're calculating whether you have 15,000 or fewer employees, or 5 billion or less in annual revenues, you have to include your affiliates. And as we'll discuss later, that can be, become a pretty difficult calculation. Affiliates at the highest level, the kind of test for affiliates is you look at 50% or more equity owners, and you go all the way up the ownership chain, and then you and then you see who those entities own 50% or more of, and then that's your affiliate group that you need to consider for the eligibility tests, and then other considerations such as whether anyone has borrowed under the primary market corporate credit facility or participated in the primary market corporate credit facility, or whether they've borrowed under a different Main Street lending facility, because the entire affiliate group has to borrow under the same Main Street lending facility. You must be a for-profit business. The Fed has recognized that not-for-profits are important to the economy and in need of help, and they've announced that they've said that at some point they will announce a program for not-for-profits. But at this point, it's for-profit businesses only. The business must have been established prior to March 13th, 2020, which was the original date that they announced these programs. You must be created or organized in the U.S. with significant operations in the U.S. and a majority of employees in the U.S. And that's at least 50% of your assets, net income, annual net operating revenues must be must be in the U.S. A borrower and its affiliates may not participate in any of the other Main Street lending facilities, as I said earlier, or the primary market corporate credit facility. You can have participated in the PPP, and you can have received an EIDL. You're still eligible to participate in the Main Street lending program. You do have to count those amounts as debt to the extent they're unforgiven at that point. And we'll talk about the calculation for borrowing. It depends on your debt. So you'll have to consider the PPP or EIDL amounts. You must, after reasonable good faith diligence, have no reason to believe that you are an ineligible business. Ineligible business is a concept in the SBA regs. For example, banks and lenders, passive real estate companies, life insurance companies, and businesses engaged in illegal activity or legal gambling are excluded, and there are some other excluded businesses that are ineligible for this program under the SBA regs. You may not be insolvent, and you must certify as of the date of the loan that you think you have the ability to meet your financial obligations for the next 90 days. And that's after giving effect to this loan. And you don't expect to file for bankruptcy during that time. Loans with borrower must have a risk rating equivalent to pass in the FFIEC supervisory rating system. You cannot be a covered entity, which is defined under the CARES Act. And that's basically, you can't be a business of the president, vice president, or a member of Congress, or a cabinet head of the executive department. These loans are subject to cross-acceleration provisions. There will be annual and quarterly reporting requirements, which Brad will talk about later. And then you can only borrow up to a maximum amount, and that's consolidated after counting all of the Main Street loans of your affiliates as well. The program will end September 30 unless further extended by the Fed.
Peter and John, let me ask you two questions that we've had sit in. One is, can you explain the concept of PASS and the FFIEC supervisory rating system, or Craig potentially, and what that means for a borrower who may not be familiar with that process? And then similarly, we've had a lot of folks coming in and asking about the affiliate and the cross-acceleration provisions and the treatment of affiliates, and to the extent you have any thoughts on, how the affiliate is going to be used to calculate both the debt as well as the EBITDA, and potentially then similarly the affiliates being included, as you go into the calculations of the amount you can borrow. Do you comment on either of those?
Yeah, Craig, do you want to handle the pass rating?
Sorry, I was on mute. Peter, go ahead, and I'll come back to that.
So I'll handle the affiliates question. Like I said, the affiliate rule are based on the definition of affiliates in the SBA regs that apply to the PPP. So the affiliate analysis, you have to consider all of the companies under common control with your company. Now, the affiliate calculation not only affects your employee or revenue tests for the eligible borrower test, the 15,000 employees or 5 billion or less in revenues, to see if you're eligible in the first place, but it also affects how much each borrower can borrow, because the affiliate group on a consolidated basis can only borrow up to the maximum amount of whichever facility they are borrowing under. So 35 million or 50 million or 300 million, depending on what program you're borrowing under. In addition, all entities in the affiliate group that are borrowing have to be borrowing under the same Main Street lending facility. So it takes a very high level of coordination amongst the affiliate group. Now, that's okay if you're all under the same corporate umbrella, but if you have, for example, a private equity owner or a wealthy individual entrepreneur owner, you may not have insight or control, or you might not be privy to the business decisions of your affiliate companies. They may be completely unrelated as far as you're concerned, except that you have common ownership. This will be a common problem with companies that have private equity sponsors that own 50% or more of the company. So there will take a large amount of coordination with your affiliates to make sure you're borrowing under the same facility, so that someone else doesn't borrow under a different facility and disqualify you from borrowing under the facility that would work for you. But it also, you do have to consider it on a consolidated basis when you're calculating how much you can borrow. And we'll talk about this in a second, but it's based on a multiplier of EBITDA. So you'll have to consider the affiliate group on a consolidated basis, as well as the borrower itself, when you're calculating your multiplier on EBITDA. But it also depends on outstanding and committed but on undrawn debt. And so you'll have to consolidate that as well. So for certain companies, especially private equity controlled companies, it's going to be a difficult test. There's going to take a lot of coordination, and it's going to disqualify some people that wouldn't just simply have been disqualified under the 15,000 employees or 5 billion or less revenues. So it's going to take some coordination with your affiliate group and some analysis of the affiliation rules themselves.
One interesting thing that was observed is if you look at the model language on cross acceleration and cross default, it makes references to affiliates as well. So if the lender is planning to use the model language that the Federal Reserve of Boston has issued, that cross acceleration mechanism actually applies to affiliates as well. So something to be aware of if you're dealing with the affiliate issue, that potentially that's going to come down and then start to trigger cross accelerations in the various affiliates with whom you're applying. As to the FFIEC piece, and Craig, jump in if you want to, that is a rating system that the banks use that looks at credit that is defaulting or potentially could default in the near term. In essence, this gets back to that purpose, that this is not for businesses that are going to fail. This is supposed to be at market or near market rates, and therefore if you have prior defaults or you have indicia or indicating that you're going to default in the near term, there's a potential that your bank or lender could have qualified you lower than a pass in the rating system, and so that is potentially a disqualifying factor.
And I would just add back to that, for those that aren't familiar with the financial services regulatory framework, that's going to be reported by the lender themselves, not any representation that you're making about the loan. It's going to be how the bank is qualifying that actual credit in their portfolio. Do you disagree, Brad?
No, that's exactly right. So, Peter, sorry for the divergence there, but thanks so much.
Next slide, please. I think at this point I did want to underscore something that's that maybe is obvious from having gone through that timeline before, but I think isn't really important to mention. This webinar, while it was scheduled last week, and as Brad pointed out, coincidentally comes at what might be characterizable as the kickoff of this program. The reason why I mention that right now is because while the terms have been changing, I would guess they aren't going to be changing that much more. So, and when I say the terms, I mean the terms of the facilities that are being put in place under the Main Street Lending Program. Chairman Powell said he thought it would go active this week. I think a lot of our lender clients are prepared to start, making loans, taking applications, making loans, but they want to see that, all the pieces have stopped moving. And I think that what they telegraphed in the press release yesterday was, this is pretty much it. If people want to start taking applications under the program and submitting them to the Fed, it's just a matter of qualifying as a lender, an eligible lender. And obviously most banks will qualify fairly straightforwardly. So, they haven't announced that they're kicking it off, but they've come as close as they can. So these terms we don't expect to change much more. And I'm going to kind of walk you through at a high level what each of the facilities are, and then I'm going to allow Peter Strand to talk a little bit about how things have changed from what they had been. And I think the general theme to take away from there is, they're just making more money available to more possible borrowers. So the first facility is the new loan facility, and this is distinguishable from the priority loan facility and the expanded loan facility in two ways. It's distinguishable from the expanded loan facility because it's a new loan from the lender to the borrower. And the second thing is the priority loan facility is a little bit more, shall we say, aggressive loans that are also new. So those two facilities are for new loans with that lender to that borrower. And the expanded loan facility is kind of thought of as a piggyback situation where you're piggybacking on a previous credit relationship. As you can see, all of the terms here, and I'm not going to go through them bullet point by bullet point, but very generally, 5-year loans, that minimum size is $250,000, maximum is lesser of these two measurements, $35 million, or a rather complicated EBITDA calculation. Basically, it's intended to be as borrower friendly as possible. And the reason why the banks are going to be willing to do that is not only are they going to get these transaction fees that you'll see at the bottom of the slide there, 100 basis points, and loan origination servicing fees of 100 basis points, but also because they're going to be able to offload most of the risk. So those basis points are measured against the total loan, but not all that risk is remaining on the balance sheet, which is the secret sauce here, of course, is getting the loans off the balance sheets of the banks. And you can see that, you've now got principal deferred for 2 years, not just 1 year, your principal payments, and you've also got amortization stretched way out. So this is very attractive money. And the terms of the interest rate is about maybe what you would expect, but it is something that people can depend upon. So that's another piece of the puzzle that's worth underscoring. Peter, do you want to talk a little bit about the differences, the primary differences between what we knew a week ago and what we know now based on the FAQs?
Yeah, I do want to cover, just as a reminder, last week, the Fed released an avalanche of documents and an updated FAQ, but a lot of that applied to the lenders. It was the paperwork between the lender and the Fed to set up the participations and the SPV, and to make the lender, the bank, eligible to participate in the program. Really, there were some tweaks, but really there weren't a lot of substantive differences to the borrower. But last night, the Fed released a new term sheets and changed some of the terms of each of the facilities to make the loans more attractive to borrowers. And so these are the kind of substantive changes. The maturity was extended from 4 years to 5 years. Like John said, the principal is now deferred for 2 years, while it had previously been deferred for 1 year. The minimum size was decreased and the maximum size was increased. And then the amortization was changed to match kind of to backload the payments, just like the other facilities were. Previously, amortization was straight line, a third in years 2, 3, and 4, and now it's 15, 15, and 70% in years 3, 4, and 5. I think you go ahead, John. Sorry.
I was just going to say, we probably should have said this up front, but this slideshow is very similar to a slideshow we gave about a month ago on the program when we thought it was going to be kicked off by, end of April, early May. And the blueprint you see on the screen, like the 5-year maturity is in blue versus was 4 years. That's the new stuff that came out in the last couple of days. So I just want to underscore that so that people, if they hadn't picked up on it already, this is our kind of version of redlining the document.
So the next page sets forth the kind of calculation of your loan amount size under the new loan facility. The maximum loan size is the lesser of 35 million or an amount when added to existing outstanding undrawn available debt does not equal 4 times the company's 2019 adjusted EBITDA. And so by way of example, if Company A has bonds outstanding of $20 million, an undrawn credit line of $30 million, and 2019 adjusted EBITDA of $15 million, you would look at the existing outstanding and undrawn available debt equaling 50 million. You'd look at 4 times EBITDA, adjusted EBITDA of 60 million, and then you'd take the difference between those, or the amount that the EBITDA multiplier exceeds outstanding and undrawn available debt, and you'd get $10 million. So the loan amount under this example would be $10 million, which is the lesser of 35 million and the EBITDA formula.
One thing I would add here is the basic frustration with this program continues to exist, in the sense that there's a lot of businesses where they're not going to be able to borrow very much money because of this EBITDA calculation and their outstanding debt. So I think that it's unfortunate that they have, while they've raised the ceiling, the $35 million, they really haven't solved the problem that we hear a lot from our clients. Next slide.
Yeah, and Peter and John, one question as we shift to the next slide that was posted in. Are there restrictions in this program similar to what we saw with the PPP regarding how you can spend the money? Just kind of in terms of fundamentally how this is going to stack up against the PPP that had those really strict controls on the uses of these funds?
Yeah, I mean, in short, and we'll talk about this a little bit later, but in short, no, there are not the restrictions that you have, the permitted uses where you have to use it towards payroll, you have to use it towards rent. This is really a general loan to be used by the business the way they see fit, except there are restrictions on repaying debt and paying down existing debt. So that will be the big kind of restriction on the use of the funds, but this can be used, in kind of the general working capital or other purposes.
Now we're on to the priority loan, the Main Street priority loan facility. As I was saying before, this and the Main Street new loan facility are both facilities that are focused on new credit to a given borrower. It's interesting, and Peter can underscore this, but basically if you look at the terms here and you look at the blueprint and so on and so forth, what you'll notice is these two loan facilities originally were supposed to have one of them be available to pretty solid credits that maybe were even known to the lender even if they didn't have credit outstanding at that point in time. That's what the new loan facility was, even though it was going to be a new loan. and then a priority loan facility was maybe some credit that was a little more aggressive that the bank felt less comfortable about lending to, but because they could offload quite a bit of it, they would be able to make the loan. The thing that's interesting is these two facilities have become very, very similar, given the recent FAQ that was put out. So that there's the only significant difference that has survived and continues to survive is the size of the loan is higher under this facility that can be made, both in terms of the $50 million ceiling and versus 35 under the new loan facility, and the 6 times 2019 adjusted EBITDA versus 4 times adjusted EBITDA. So those are the important kind of differences about where you might go if you want to get borrow some money from a bank under this program. I think that it's interesting that 6 times actually is helpful. The 4 times is not as helpful from our experience talking to clients. It's just not enough headroom for them to borrow much money, because, for instance, real estate companies often already have committed credit in place for 5 times adjusted EBITDA. So anyway, Peter, do you want to walk through the differences here between what was and what is now based on just the last couple of days of guidance from the Fed?
Yeah, the differences are very, very similar to what I said in the new loan facility. The minimum size has decreased, the maximum size has increased. The maturity is 5 years as opposed to 4 years, and principal is now deferred for 2 years. Really now, as far as I see, the only difference between this program and the new loan program is the 6x adjusted EBITDA multiplier, and the maximum size is larger. So you might ask yourself, well, if I qualify for a larger loan under this program, under the priority loan facility, why wouldn't I do the priority loan facility and not the new loan facility? And that's a good question. Currently, I don't have a good answer for that. It seems like the Venn diagram of these two programs, the new loan program is subsumed by the priority loans program, but we'll see, based on implementing guidelines that we get between now and when this program really takes off.
Next slide.
This is an example of the priority loan program. The Company A, again, has the exact same $20 million undrawn credit line of $30 million and 2019 adjusted EBITDA of $15 million. Therefore, the debt is $50 million, the 6x EBITDA is $90 million, and so the formula yields $40 million. Now, previously, there was a cap on 35. There was an additional cap here, an additional test, and that was you cannot exceed 35% of your undrawn and outstanding debt, and they removed that as well. So now you have this would yield a loan amount of $40 million, which is just simply the lesser of $50 million and then the EBITDA formula.
Now that's an important change, and it is, like we said in the beginning, part of the overall theme here, that they're trying to make the program more useful. Next slide, please. So this is perhaps the most complex, but also perhaps the most useful of all the 3 programs. This is the expanded loan facility. This is for a situation where you already have a credit relationship with the lender, and the Fed just wants to piggyback off of that relationship. It means that the money that's going to be available is going to be much greater because there's much more confidence in pre-existing relationships than there are those that just occurred, and it's also means that it's probably going to be more useful to all parties. There's been some changes, but the basic terms are kind of outlined here. I'm going to let Peter walk us through what the differences are. But you can see, I'll just pick on one, that maximum size has gone up from 150 to 200 up to 300 million. And then the commitment level, it's the same as or similar to what you saw under for EBITDA is similar to what you saw under the priority loan facility, where there's 6 times EBITDA. I think that it's probably worth noting that this isn't as lucrative for the lender. I'm not sure what the logic is there, but instead of getting 100 basis points for a transaction fee, they only get 75. I think it might be that the Fed just doesn't think there's going to be as much work to be done. And the same is true with the loan upsizing and servicing fee of 75 instead of 100. So, and both those, I think both those are worth focusing on if you're a lender, but if you're a borrower, it doesn't really matter because it's all going to be passed, it's going to be, well, I guess it does matter, but it's all going to be a bit transparent to you. Anyway, Peter, do you want to walk through the differences here?
Yeah, just that the expanded loan facility, like John said, is available for those borrowers that have existing loans in place, and then the Fed will purchase a participation in an upsize of that loan. The numbers here are significantly kind of the scale of this program is much larger compared to the other programs. The minimum is $10 million, and that will limit many participants. And then the maximum size is the lesser of 300 million or 6x adjusted EBITDA. They have removed the requirement of 35%, another limit that the borrower's existing outstanding undrawn debt is 35%. So other than that, there haven't been much changes to this program other than the loan is now 5-year maturity and the principal is deferred for 2 years.
Next slide, please.
By way of example, Company B has similar debt levels. They have an existing term loan outstanding of $20 million with an eligible lender, an undrawn credit line of $30 million, and adjusted EBITDA of $15 million. If you put those numbers in and you take out the limit of 35% of undrawn debt, you end up with a loan size or an upsized tranche of 40 million, which is the lesser of 300 million and $40 million. Previously, using these numbers, they had been constrained by the 35%. So this company is one of those companies that will benefit from the removal of the 35% of existing debt cap.
Peter and John, one of the questions that was posted is the adjusted EBITDA calculated on a consolidated basis, including the affiliates, kind of in follow-up to our discussions earlier about affiliates and what impact those affiliates would have on those adjusted EBITDA calculations?
Yeah, the borrower has to meet the test so that our borrower runs their own calculations, but then the affiliate group as a whole is also constrained by whatever that maximum size is. So you'll have to run 2 calculations and then use the lesser of those 2 calculations. Or you need to make sure that you meet the requirements on a standalone basis and then under an affiliate group basis. And again, your entire affiliate group, whoever's borrowing in your affiliate group, has to be under the same facility. So you all have to do new loans, or you all have to do priority loans, or you all have to do expanded loans. There's no, once you're in one bucket, you have to stay in that bucket. The whole affiliate group does.
Next slide. Before we start going through these attestations, I did want to underscore, a couple of things about the program. These are loans, right? So a lot of borrowers aren't going to be really as interested as they were in the PPP program, where there's loan forgiveness. And these are loans on good terms, but they still have to be repaid. So I think that it's probably worth saying that out loud because this isn't any kind of a giveaway program. And while some of the things we've said before kind of underscore that, any Section 13(3) program that's run by the Fed can't be a giveaway program, but it's important to kind of remember that this is really, is this good borrowing to be done? Is this something that you really should do? I don't know. As you'll see from the attestations, it's really for those borrowers who can't secure credit otherwise, but need the credit to make it through the crisis. Go ahead, Peter. Do you want to walk through the attestations?
Yep, absolutely. So borrowers will need to make certain certifications and covenants in order to receive these funds. They must certify that they're unable to secure adequate credit accommodations from other banking institutions. And you'll see that that doesn't mean that you can't get credit at all. It means you really can't get credit on favorable or attractive terms. You have to certify that you're not insolvent, that you're going to be able to meet your payments for the next 90 days after giving effect to this loan, and you don't plan on filing for bankruptcy during that time, during those 90 days. Could
you go back to the previous slide, Brad?
Absolutely.
You may not use the loan proceeds to pay other debt unless mandatory and due, provided that a priority loan may be used, and only a priority loan, so not a new loan or an expanded loan, but a priority loan may be used to refinance debt at the time that it's originated, as long as the debt is not with that lender, with the eligible lender that's lending under this program. The borrower may not cancel any open lines of credit. And then there are statutory restrictions in the CARES Act on stock repurchases, dividends and distributions, and executive comp. And you're going to have to meet those, you're going to have to follow those restrictions during the life of the loan, and then for some of those up to 12 months after you have paid off the loan. So those can restrict you as well. You must use commercially reasonable efforts to maintain payroll and retain employees. However, in the FAQs, there's a significant amount of wiggle room there. And then, as I mentioned, borrower may not be insolvent. Additional attestations on the next page.
Well, one question I had, Peter, that a number of borrowers have been asking is, this certification, do we think that's falling in the wake of the PPP lending program? Meaning, that they're trying to get ahead of that issue and talk about this necessary or necessity certification or a standard less than that. I mean, do we think that's an offshoot of that?
Yes and no. The PPP, because it's a grant, they want to make sure that the right people are getting this government help. I mean, it is money, it is a gift from the government. So they want to make sure that it's going to deserving and needy parties. And that's kind of the basis for the economic necessity loan and the various guidance they've put out based on that loan. The kind of economic considerations for this loan is less who is absolutely needy and who is deserving, and more so who is it going to help. The goal of the Fed is a little bit different than the goal of the PPP program, which is really, to maintain payroll and to get money out to employees. The goal of this program is to, keep companies healthy, but at the same time not unduly risk money of the government. So there's a kind of a balancing act, and I think because it's not a gift, they're just trying to determine how they can keep the credit markets liquid, but at the same time not waste money.
I would amplify that. I would amplify that the response just a little bit. So, first of all, the PPP program, when it first came out, was perceived to be something that everybody could qualify for pretty easily because only a certification had to be made. Once there was the realization that a lot of larger businesses had qualified, even some public companies, I think the Treasury kind of reversed course and tried to make it clear that, true small businesses were the intended beneficiaries of that program. And that's where a lot of the risks started coming up and the need for people to reconsider whether or not they really should accept the money. I think in this case, it's a very different kind of playing field. I think in this case, The Fed has always been, just like you look at the primary market corporate credit facility, for example, as Peter said, liquidity in the credit markets is the main thrust of these Fed programs. In that case, they're willing to lend money to investment grade companies, not, public companies, not exactly, your average small business. Here, it's remarkable if you've been following how this has been developing. They've taken it from being, a program that was really focused on mid-sized companies to a program that's really open to all comers who can at least make these certifications. And I think that the certifications, I don't think we're likely to see as many lawsuits in this area. I think that there's some real popular support for the Department of Treasury and others to go after people who got $10 million loans under the PPP program, who got in the way of, since the money runs out, they got in the way of smaller businesses who were unable to recover from, the COVID-19 crisis because they couldn't get access to that program. So there's going to be probably a public appetite for some sort of enforcement there. I don't see that as much of as being as much of a problem here with the certification that's going to be required. That being said, we probably don't want to leave this page and the next page without saying one simple thing. Every time you borrow money from or you take advantage of a government program like this, it's a little bit of a bargain with the devil, and you need to remember that going in. I've had lots of conversations with people who were kind of unsure of what to do about their PPP money once the increased guidance came out. And the thing that I always tried to point out to them was that, you really have to be aware of the fact that you're getting yourself into a system if you take this money. So you should take the money if you really need it to keep your business going, or you think it's absolutely prudent to do it, to keep your business going in a way that is going to be successful and allow you to survive the COVID-19 crisis. But you have to be cautious about the fact that you're getting in bed with the government. The government does have very particular goals, and they aren't shared with most businesses for how things should happen. And they're also a little quixotic. They can change their mind about regulations. They can change the terms of loans. Not unilaterally in this case. I don't expect that to happen, but the circumstances under which, or the regulations under which these loans are kind of supervised may change in a way that would make you uncomfortable once you're already got the loan. So I think that's a caution that's worth mentioning in this context. I'm sorry, Brad, you're going to ask another question?
Yeah, before you guys go to the next slide, there was a question that was posted in about whether or not there are personal guarantees that are required under any of these facilities, and is that being mandated by the Federal Reserve? And I believe the answer is no, but wanted to pose that out to the group in case you've seen anything that may indicate that there are the potential for personal guarantees on these.
Yeah, I've seen nothing. We'll mention it on the next page, but if you are a holding company, then your operating subs will need to guarantee this loan, but that's the only kind of mention of guarantees under this fund. There are no personal guarantees at this point.
Yeah, great catch there, Peter. And I'll flip you over to that next slide.
So moving on the required attestations, this second bullet is, I think, an important one. If you're a subsidiary of a foreign company, a U.S. subsidiary, you are still eligible, but you have to represent that you will use the proceeds of the loan only for the benefit of yourself and your U.S. subsidiaries and your other U.S. affiliates, and that you will not use the loan, the proceeds for the benefit of any foreign parents, affiliates, or subsidiaries. You have to rep that you and your affiliate group have borrowed under the same Main Street facility, and that you have not participated in the primary market corporate credit facility. As I said earlier, if you're solely a holding company, then you need the loan fully guaranteed by your subsidiaries, by our operating subsidiaries. Under this additional borrower covenants, it's important to note that you will need to notify your lender of any material changes or breach of your covenants and certifications. You also have to acknowledge that you'll be subject to criminal and civil action for knowing material misrepresentations. A big one there is the False Claims Act, especially since you will be making these representations to a federally insured depository. as well as the Fed. So that's a big one. We've written on that before. And to John's point, you just have to be aware that you are opening yourself up to criminal and civil action for knowing material misrepresentations. Also, any loan under this will be immediately due and payable upon discovery of such a material misrepresentation or breach. And the Fed and Treasury, this is a big one, will most likely disclose the participants under these programs to the public and the amount of the loans. So just be aware that if you participate in this loan, your participation will become public. And there are record retention requirements as well.
I think that I wanted to go back just for a second to the question about guarantees, and obviously Peter pointed out what is pretty common when you have a holding company and operating subsidiaries, that you'll have to get guarantees from the operating subsidiaries if you're borrowing at the holding company level. But to go back to the question about personal guarantees, while we don't have any clear guidance on it, if you're expanding your credit relationship with under the Main Street expanded loan facility with a given lender, as a borrower, you're going to have to give the same, the loan has to be made, the upsized tranche on lending under the expanded loan facility is going to have to be made at senior or pari passu in terms of priority and security to other loans that are already outstanding. Now, whether or not that encompasses a further personal guarantee, if there is an existing personal guarantee, I don't know, but I suspect that's what you're going to be left with. So I just wanted to kind of underscore that for people who are trying to figure out the answer to that question. As Peter said, we'll probably get more guidance in the near future, but I think if you have an existing loan and it involves a personal guarantee, you may be stuck getting a personal guarantee with respect to the expanded loan. Next slide.
And so then when we talk about some of the general considerations for borrowers, we wanted to flag in particular to you, these are some things that have made a lot of the headlines recently. We want to make sure you're aware of as a borrower as you're considering potentially participating in the Main Street lending program. Understand that both Treasury Secretary Mnuchin as well as Chair Powell has recently made a number of statements about the transparency they envision for the Main Street lending program. Not only are they making those comments in Senate testimony and on various news programs, but similarly, the Fed has said that you should expect that at some point in time, both the names and details of each of the participants will be disclosed, how much you borrowed, the interest rate or discounts that you paid, types of collateral pledged or assets transferred, that's really key, that may become public, and then also information on overall cost, revenues, and fees. So if this is something that you're considering, just understand that just like there was pushback in the PPP program for certain entities, make sure that you're planning on the fact that it is likely that information will become public. And to the extent that would give you any concerns, either from a disclosure standpoint or from a reputational standpoint, make sure you're planning for that, because there's been various commitments in those various circumstances as to increased transparency for the Main Street lending program. One interesting change for lenders that we flag because it may impact some borrowers is a lender can state that a condition of the loan is the Federal Reserve's commitment to participate, meaning that the Federal Reserve has committed to take out 95% of the loan off the books of the bank. And so it is possible, in fact, highly likely, the number of lenders who make loans under this program will say that the final funding of that loan is conditional upon the Federal Reserve Bank of Boston's SPVs agreeing to that participation. One really interesting issue to address, and I will say these are found in Appendix C, as in Charlie, of the new FAQs that were released last week. But there are significant reporting metrics that you will have to keep up with as a borrower. There are 42 different reportable metrics that are required annually. Those go both to your lender and to the Federal Reserve as the participating lender. And then there's between 22 and 42 different reportable metrics, depending on whether you're in one of the new /priority loan facilities or the expanded loan facilities. And so you're going to have to make sure you're tracking and reporting assets, cash, liabilities, debt, revenue, in essence, a fairly robust overall financial health reporting on a quarterly basis, and then similarly on an annual basis. And so you need to make sure you're prepared to deal with that level of reporting, particularly given sometimes there's a very tight relationship between the lender and the borrower, where they may not be actually collecting all of these reports, especially on a quarterly basis. All of these are now mandated in the Main Street lending program, and so you'll see all of these incorporated into your loan documents. Need to be prepared. There are going to be fairly robust reporting requirements on a quarterly or annual basis. Before we shift slides, any comments on that, Peter or John?
No, but I think it goes to your next slide, which is a lot of people are hesitating about whether or not to participate.
Yeah, great point, John. And so these are some of the criticisms that have been leveled. A lot of these are taken from the American Banking Association, the Independent Community Bankers Association, other industry groups. Generally, during interviews, there has been something of a lack of interest from borrowers. As we said, if you look at the rates that are being charged, LIBOR plus 300 basis points, the requirements to participate, the reporting obligations, these look like fairly market term loans. They're not grants, they're not extremely sub-market. And so candidly, a lot of bankers are reporting that there's not a lot of interest from borrowers. They had folks knocking the doors down for PPP. Here, not so much. Part of that may also be the fact that when you look at the ecosystem that's currently supporting commercial lending in the country, a lot of lending is being done through non-bank lenders, where they're creating debt facilities for various borrowers. One of the things John had mentioned earlier and Peter echoed is that this is only available to chartered financial institutions. In essence, insured depositories are the groups that can make these loans. And so that whole section of the economy that is represented by non-bank lenders in the commercial space can't participate in the Main Street loan program. And if you think about the requirements on the new loan facility, the priority loan facility, and expanded loan facility, you've got to work with a consortium of all those lenders to bring them into line, especially if you have collateral that's being pledged to secure these loans. Unsecured may be slightly easier, but if you think about some of the requirements, and John and Peter may have additional comments on this, where you have to either have this Main Street loan sitting in a priority position compared to existing debt, or in pari passu with existing collateral. That means, in essence, you're going to have to get these consortiums of lenders, including the non-bank lenders and non-chartered lenders who cannot participate in the program, to all come together and either execute subordinations or coordinate those efforts, so that particularly when you have multiple affiliates, you can bring all of those together into this one massive program that's going to be represented by the new Main Street loan. Let me stop there. John or Peter, any thoughts on that?
Well, I mean, I think it's a significant, there's a few points that you touched on there that are very significant. One of them is that, eligible lender is insured depository, as you pointed out. And there's a lot of people who are at the margin in our society who are, from a business perspective, they're borrowing from these non-bank lenders. And you're right, as more of that has occurred, the less impact what the Fed does through insured depositories it will have on the environment as a whole. The other thing that's important that people forget about is, except for those people in those industries, is this is not very helpful to the real estate industry, and it's not very helpful to the financial services industry. So those non-bank lenders themselves that are in difficulty or finding challenges are not going to be able to take advantage of it. So what we have is as you kind of alluded to, but didn't put quite as fine a point on as I would, is the shadow banking market that has developed over the last 10, 20 years that the Fed and the SEC have allowed to, and the FDIC have allowed to develop, and Congress has allowed to develop, has decreased the Fed's ability to have a direct impact on middle market companies and smaller companies, because they used to be working through, literally, 30 years ago, there was twice as many banks. Now, even though bank assets probably haven't gone down that much through consolidation, it's just larger players that are having more of an impact. A lot of those larger players aren't playing in the middle market. So you have a situation where you can't really easily reach these middle market companies through the current banking structure and system. And so it's a real flaw in this program, and they haven't really figured out how to address it. And a lot of the other things that you mentioned in this list are just reflections of frustration with the program, because insofar as those banks don't have relationships with people who need the money, it might be easier to develop those relationships if some of these terms were a little bit more generous. For instance, there was a grant that was available or something like that. I hope the Treasury will consider putting in place a program that's not going through the Fed that would allow them to do more of this sort of thing. Maybe it would be more popular, but I don't really foresee that happening at this point in the business cycle.
And kind of on top of that, you see a lot of pushback from certain borrowers because, as noted previously, the longest these facilities will run is 5 years. And that creates really two offshoots. One, that potentially could violate covenants and restrictions in your existing loan agreements because you would have debt maturing in a shorter term than the existing debt obligations that you have outstanding. But one of the big concerns, and I think it's going to be interesting how the Federal Reserve adapts this or deals with this going forward, is if you think about how short of a window we have presently for Main Street lending. You know, today we're early June. It's going to close on September 30th. You fast forward 5 years to 2025, and within the space of under 3 months, you're going to have all of these loans suddenly coming due, particularly those that were backloaded that had the 2 years of deferral and then the 15-15-70 mechanism for the repayment in terms of how you're amortizing out the loan. And with that said, you're going to have this huge chunk of loans for fairly significant dollars all coming due in a short time, and there's still some questions about whether the financial services sector is able to eat that type of volume in June, July, and August of 2025. Yeah, one thing that was touched on earlier, and unfortunately it's something that's not yet been addressed, is if you have REITs or you're doing distributions incidental to a structure or transaction or distributions to parents, so far there has been no accommodation made for that. The only accommodation so far made for distributions that would be in respect to equity has been tax distributions for S corporations, meaning to cover the S corps partner liabilities for taxation on a flow-through basis. Short of that, there's been no structure or no FAQs issued yet accommodating other tax distributions or any of these other what we would consider equity-like distributions, but are fairly standard within the various sectors. One significant challenge to be aware of if you're a borrower is the way the share repurchase prohibition is written is it is for the term of the Main Street loan plus 12 months. And so that may impact your ability to retire convertible debt. There's also no provision that terminates these restrictions upon payment in full. That may be just a gap that's going to be addressed by the Federal Reserve eventually. But as it stands now, the prohibition is the term of the loan plus 12 months. So it's possible you could fully repay your obligation when it matures or even pay it early, and you'd still have that 12-month tail that's sitting behind the obligation that continues to restrict you. And then obviously we've been touching on a lot of the affiliate issues that have to be addressed on a go-forward basis and the restrictions that apply to those affiliates. Before we go to the next slide, I do want to pick up one of the questions that someone sent in, which is when we say overall costs and revenues will be disclosed, does that mean annual revenues and costs of the borrower? The initial disclosures appear to reflect the revenues and costs to the lenders, meaning the lender and the Federal Reserve participating, but there are reservations that any of the submissions that you provide as a borrower potentially are subject to disclosure on a certain schedule that's going to be finalized. So I think as you're applying for this, if you're concerned about any of the disclosure of that information in Appendix C, which is that checklist of disclosures, you need to be talking with your advisors or attorneys about whether or not that is a significant concern for you or your business, because there is a high likelihood that some of that information will eventually be made public as part of the transparency operations within the Main Street Lending Program. Before we go to the next slide, I'll turn it over to John and Peter in case you have any additional thoughts, but I will say one of the last slides we have in this presentation are links. Obviously, these slides will be made available on our website. They'll be sent to all the participants. It has links to the various FAQs, as well as the borrower covenants and restrictions that you may find helpful. That way you've got one easy one-stop shopping, as it were, with links to each of those, including their updated locations. With that, before we sign off, we would certainly be happy to take any questions. Feel free to send those in. I'm also going to open it up to John and Peter and Craig for any comments here. Before we do close down, Thursday we will have our Continuing in the Trenches series. This one is focused on the lenders again. It's focusing on the digital banking transformation. So I'd invite any of you who want to participate in that to feel free to email any of us. We're happy to help you with those registration links. But that'll be occurring on Thursday. And obviously, John and Peter and the entire Main Street lending team here at the firm have been posting regular updates. So those are all available on our website, including they've already posted updates about a very detailed list of the changes that came through last night and the changes that occurred at the end of last week and over the weekend. So let me turn it over to John and Peter with any final comments, and then I will pick up one question about when is the principal due dates for the amortization, meaning is it on the anniversary of the loan or is it on the end of the year, meaning if you took it out in June of this year, when would actually those payments become due when you hit year 3, when you have that first payment and it begins to amortize? So, let you either jump on those or other final thoughts or comments.
Yeah, closing thought for me is if you are interested in pursuing this program, kind of the next step is to find an eligible lender, which, as we said, is going to be a bank, insured depository. They will be using their own forms, lending forms, which will be tweaked for this purpose, and they will be going through their typical underwriting and know your customer procedures. So there's some reason to go to a bank with which you have an existing relationship because the know your customer procedures and the onboarding procedures are simplified for them if there's an existing relationship. But they will be able to guide you through the process and provide you with applicable forms once they're set up for it.
The only thing I was going to say with respect to the program, I think what you're going to see is a lot of people are going to look at this as maybe something that they would take out and repay earlier rather than later, and that's the real attraction to the program, because there's the deferred interest and the deferred principal payments. Those are I'm not sure of the answer to the question. Maybe Peter has an answer, or you do, Brad. But I think it would be 2 years from the date of the loan was made. But setting that aside for a minute, I do think that the attractive quality of this is the short term. The differences between this and a market rate loan, which are the short term deferral of interest and principal payments. So, and the fact that you can prepay it without any kind of a penalty. So I think those are things for borrowers to think about before they discount the program completely.
Yeah, great point there, John, and you're exactly right, which is it appears through the documents that have been submitted by the Fed that that principal and interest deferral would be, in essence, for 24 months from the date that you obtain the loan, and during that time, that interest is capitalized. It's not that there's no capitalization of interest. It does apply, and it's being capitalized into the balance. And then starting in presumably month 25, you will then begin making your first payments on that amortization, either the 15, 15, 70 or the 33, 33, 33 model, depending on which of the facilities you're participating in. And during that time, that interest would have been capitalized and added to the balance. So,
I mentioned this. Yeah, go ahead. No, I was just going to say, I mentioned this because, obviously you need to consult with your lawyers to figure out exactly, and with, you need to consult internally about your, financial requirements before you decide whether you need to embark on this. But it's something that I saw a lot in the PPP program, and something that you have to kind of face here, which is, what's the net effect? The net effect of the PPP program was simply to keep people, especially in its original incarnation, though terms got a little bit better, to keep people on the payroll and use small businesses as a pass-through entity to get money out to individual employees. The net effect of this is really to try and give people liquidity, businesses liquidity, for the year or so, 18 months or so, that the government thinks or thought that the COVID-19 crisis would adversely affect the economy. That's the net effect of these loans. So that's why what Brad just mentioned is important. And if you feel like your business has been really hampered by COVID-19, or by coincidence was hampered anyway, and COVID-19 just made things worse, then this could be exactly the right solution for you to provide liquidity, increased liquidity for your business over the next 18 months or 24 months, when you aren't having to make any interest or principal payments. So I think that's the takeaway I would leave with people. And if they have any other questions, they can reach out to us.
So with that, thank you so much for attending today. Obviously, we'll continue to post updates as they become available from the Federal Reserve. I'd really like to thank all of our presenters today for their insight and input. And obviously, if you, in follow-up to the presentation today, have additional questions, concerns that you'd like to raise with any of us, feel free to reach out. Our contact information is in the slides, or you can reach out to Clara Kuhn, who is our coordinator for these presentations. I want to thank you for what you're doing and for continuing to assist America's small and mid-sized businesses as they face what is an unprecedented crisis in our economy. So with that, thanks so much to all of our participants. Thanks for joining us today. And should you need it, the recording of today's webinar is available on our YouTube channel as well as on the website. And the slides will be posted to the website and sent to all the participants today. Hope you're having a great day. Stay healthy, stay well, and we will see you next week. Thank you so much.
Thank you, everyone.